Felix here, and today we're diving into a topic that's been on many investors' minds lately. Why investing feels so bloody difficult right now. In this video, we'll cover why the current market feels challenging, the psychology behind investing difficulties, the key strategies for long-term success, what stocks to buy now, that might be the interesting bit, and a surprising sector rotation that's shaking up the market right now. If you want to learn even more, our teaching portfolio is absolutely crushing it once again. We're up over 80% so far this year. You want to learn exactly the 3 steps that we do apply to achieve that, then come and join our beginner trading training next week. felixprehn.org/webinar and grab yourself a free spot. Now, as Winston here can attest, sniffing out great investments isn't always easy. But lately, it seems like the markets have been particularly perplexing. We've got all-time highs, talks of bubbles, and enough conflicting advice to make your head spin. Let's start by looking at where we are in the market cycle after the last couple of days of dip here. The S&P 500 and other major indices have been hitting record highs repeatedly over the year. Naturally, this has a lot of investors feeling nervous. After all, what goes up must come down, right? Well, not necessarily. Here is a stat that might surprise you. Since 1950, the stock market has hit over 1,250 all-time highs. That's an average of 16 new records per year. So while it might feel uncomfortable to invest at these levels, history shows us that all-time highs are actually quite common in a healthy, growing market. But I know what some of you are thinking. Felix, this time it's different. The market is clearly overvalued. It's collapsing. And I hear you. I really do. The 8% pullback of the Nasdaq in the last few days has a lot of people worried. But here's the thing. People have been saying the market is overvalued or crashing for years. In fact, during the bear markets of 2022, my comment section was full of people convinced we were headed for an even bigger crash. Fast forward to today, and those same doom and gloom predictions didn't pan out. The market rebounded strongly in 2023 and has continued to climb in 2024, well, until it tanked the last few days. This brings me to a crucial point here. Timing the market is incredibly difficult, if not impossible. Even the most legendary investors don't really try to predict short-term market movements. The traders do, and let me show you what they're doing right now. If you head over to tradevision.io, and I put the link down below, you can click on Smart Money, and that basically shows you dark pool trades. And I can see just from the last couple of hours of trades here, the largest trades out there, all in the millions, and what they're doing. And guess what? They're bearish. They're selling mostly the index, S&P, IWM, mostly sells. But if you scroll down a little bit further, you'll also see some of the big stocks being sold. Google here, 7 million sell order, or EFA, or American Airlines, or Microsoft, another 1.2 million sell order there. This gives you a pretty good insight into market sentiment right now. So might be something you want to play around with. You get yourself a 1-month free trial for this if you just head over to tradevision.io. And that's not some random piece of software I'm peddling. I don't really endorse anything ever. It's something we're building to give you access to the same data I used to have when I was on Wall Street. Well, I wasn't actually on Wall Street. I was on the trading floor of an investment bank in Hong Kong, where I'm right now. Now, I'm not saying the market can't or won't go down from here. Corrections and bear markets are a natural part of the cycle. In fact, on average, we see a 10% correction about every 2 years. We see a 20% bear market roughly every 7 years, and a 30% plus crash happens approximately every 12 years. But here's the kicker. These downturns are actually a feature of the market. They're not a bug. They are what create opportunities for long-term investors. Speaking of long-term, let's talk about why investing feels so hard right now from a psychological perspective. Our brains simply aren't wired for the patience and emotional control that successful investing requires. Think about it. For most of human history, we've been focused on immediate threats and short-term survival. The idea of delaying gratification for decades is a completely foreign idea to our caveman brains. And this is why so many investors underperform the market. They buy high when everybody's excited, then they panic sell when things look grim. It's a recipe for poor returns and a fairly miserable life. In fact, while the S&P 500 has returned about 10% annually over the long run, the average investor has earned far less due to poor timing and emotional decision-making, about 2% on average. So what can we do to overcome these challenges? Here are a few key strategies. You might want to take notes. Adopt a long-term mindset. Think in terms of decades, not days or months. To start with, you actually need a goal for a decade. Right? Do you know what you're going to be doing in 10 years? Well, start writing it down. Second, you want to automate your investing. Set up regular contributions to remove emotion from the equation. And 3, diversify. Don't put all your eggs in one stock just because you like the haircut of the CEO or something, very rational like that. Be in different sectors. I have a lot of tech stocks. I have some early tech stocks, but I also own things like Philip Morris and the S&P and things like that. S&P Global, not the actual index. And then ignore the noise. Daily market news is mostly irrelevant for long-term investors. Short-term traders, and I do both, I trade and I invest, and I kind of give you a bit of a glimpse of why I trade. We're up 80% this year, so I enjoy it, and I take that money and I put it back into the long-term stock portfolio because that's really what brings my compounding to, glorious highs. And then you're going to want to rebalance because it forces you to buy low and sell high. And that's really a concept that most people don't seem to really grasp. The reason we buy a stock, so we make money out of it. We're not married to it. We don't care about its long-term viability. They're not children or family or golden retrievers. No, it's just a tool to make us money. Now, I know some of you might be thinking about waiting for a better entry point. But remember, time in the market. If you have a long-term horizon, the best time to invest is usually now. Well, yesterday would have been good. If you have a time machine lying around, do let me know. Now, I sometimes put out videos where I say I'm not going to buy anything right now. And that's because I also trade. I buy stocks every Monday without fail, every single week. Okay? Doesn't really matter what happens out there. I might slightly pick them and choose them a little bit different, but I do buy every week. Highs or lows. But my trading, which is my income generation, that's where I'm more the market timer. And that's a different story altogether. But investing reminds me a lot of one of my passions, which is hiking. Both require patience, consistency, and the ability to push through some discomfort. You can't cheat your way to a 3,000-foot summit, and you can't shortcut your way to long-term investing success. Just like with hiking, the key is to focus on the process, not the day-to-day fluctuations. Some days will feel great. Others will be a struggle. But if you stick with it, the results will come in over time. Now let's pivot to some exciting investment themes that I promised you that are worth paying attention to right now. As always, remember that these are areas to research further, not direct investment recommendations. Winston dug them up. So if you take financial advice from a golden retriever, then, well, you're in good company. But in all seriousness, make your own bloody decisions. First up, we've got the ongoing AI revolution. I know there's been a bit of a shake-up there in the last few days, but you might be thinking, Felix, isn't the AI trade overplayed at this point? Well, yes and no, as my favorite politicians tend to say. While the obvious AI winners like NVIDIA have seen astronomical gains, there's a fascinating rotation happening in the market right now. According to Wall Street banks, investors are starting to look beyond the usual suspects in tech and communications. They're hunting for the less obvious beneficiaries of the AI boom. Let's break down some of these emerging themes. 1. Power, energy. The surge in electricity demand from AI and data centers is putting utilities in the spotlight. Companies like Dominion Energy, ticker symbol D, and YTL Power, ticker symbol YTLPF, could benefit from this trend. In fact, the International Energy Agency estimates that power usage by data centers, AI, and cryptocurrencies could double to more than 1,000 terawatt hours by 2026. That's roughly equivalent to Japan's entire power consumption. Next, we got equipment manufacturers. Here's a mind-boggling stat. If you order a transformer today, you might not receive it until 2028. This shortage has boosted shares of companies like General Electric, ticker symbol GE, and Schneider Electric, ticker symbol SBGSY. I believe they've listed in France, but they might have an OTC listing in the US. It's a reminder that sometimes the pick and shovel plays can be just as lucrative as the miners themselves. 3. We have renewable energy. With AI's massive power requirements comes increased focus on clean energy. Companies involved in solar, wind, hydro, and nuclear power. I know nuclear power is now in the sentence with clean energy. It's baffling, isn't it? But Bill Gates does a good job with the PR there. You could see basically more attention to the whole sector. And that could be your classic, like Vestas wind systems, ticker symbol is VWDRY, or maybe just something simpler, like Tesla. I talk about them quite a lot. Next, we have copper. Even commodities have an AI angle. Copper is crucial for electric cables and cooling systems in data centers. Bloomberg Intelligence estimates, is that two words that go together? Bloomberg Intelligence? Anyway, Bloomberg Intelligence estimates that global copper consumption could be 2 million tons higher by 2030, largely driven by AI-related demand. Now, do keep an eye on companies like Freeport-McMoRan, which is ticker symbol FCX, and BHP Group, ticker symbol BHP. Just bear in mind, this could be a choppy, bumpy ride because as the Chinese economy cools, copper prices tend to come down a little bit, but that could be short-lived. And then we have data centers. Real estate might not be the first thing you think of with AI, but data centers need land, yes, and buildings. REITs specializing in this area like Equinix, ticker symbol EQIX, and Digital Realty Trust, ticker symbol DLR, are worth keeping an eye on. And then we've got the actual adopters of AI. Beyond the companies enabling AI, there are those implementing it to improve their business. Morgan Stanley, the bankers with the big golden heart, estimate that these adopters could see an average share price boost of 27% this year. They highlight companies like Deere & Co., ticker symbol DE, which I actually quite like, even without the AI play, and PACCAR, ticker symbol PCAR in trucking. Next, we got healthcare. The ability of AI to analyze complex data sets is particularly promising for healthcare. Smaller biotech stocks like Recursion Pharmaceuticals, ticker symbol RXRX, are exploring AI's potential in drug development. Now, it's crucial to note that while these themes are exciting, they also come with risk. The recent market action is a perfect example. The Bloomberg article points the Nasdaq has tumbled 8% from its all-time high, showing how quickly sentiment can shift. And this rotation we're seeing from the mega cap tech stocks to the smaller, less obvious AI beneficiaries is a reminder of why diversification is so important. It's also a perfect illustration of how the market is always evolving, always seeking out new opportunities. But here's the thing. While it's fascinating to discuss these trends, for most investors, trying to capitalize on every shift in the market is a fool's errand. Remember what we discussed earlier about investor psychology and the pitfalls of short-term thinking? Instead of trying to predict which sector or theme will outperform next, focus on building a quality portfolio that can capture growth across various areas of the market. This way, you're positioned to benefit from long-term trends without taking on excessive risk in any one area. So to wrap things up, yes, investing feels challenging right now. We're seeing all-time highs, we're seeing dips, we're seeing mini crashes, rapid sector rotations, and all sorts of new themes reshaping the market landscape. But by understanding these dynamics, maintaining a long-term perspective and staying somewhat diversified, you can navigate these waters with confidence. Remember, the goal isn't to predict every market move or catch every trend. It's to build a robust portfolio that can weather various market conditions, compound your wealth over time, and give you financial freedom. Now, speaking of building robust portfolios, if you want to potentially make income from your portfolio, this is separate from the long-term investing strategy, more short-term thinking, then come and join our webinar where Winston and I will dive deep into our 3-step strategy, all the automations, how we trade just 2 or 3 hours a week. Just head over to felixprehn.org/webinar. Link is first in the description down below and reserve your spot. And trust me, you don't want to miss this one. Thanks for watching, and until next time, happy investing. What if I told you that $50,000 could potentially fund your entire retirement? Sounds crazy, right? Well, stick around because we're about to embark here on an exciting journey with 2 big tech stocks, and for the more conservative investors, also with 2 ETFs. And I promise that by the end of this video, you'll understand a powerful strategy